Hey guys, Flippin' Landlord Ninja here with Two Guys Take on Real Estate.
Two guys take on real estate.
So today I want to take a little bit of time and talk about something that I don't think a lot of people really know or at least understand. It's called a holdback or a depreciation recapture with insurance companies, and how this is something that you might be able to take advantage of in growing your portfolio, finding a good deal. So please listen to the end so you can understand all the little steps and how it might be able to really help you in your real estate goals. As always, we're here, pay it forward so you guys don't have to. Okay, so let's first talk about home insurance and if you have a claim, kind of how it works. So you can either have like a partial loss or a full loss. And if you have a partial loss, could be maybe a small little bathroom fire or flood, or possibly a full loss where you're looking at the house is not habitable, stuff like that, where maybe you have a large fire. So home insurance companies typically pay out your replacement cost in two parts. First, you have the actual cash value, so you get that check up front. And if that's also, if you have a home insurance, if you have actually a mortgage on the property, that might have to go towards paying the mortgage off first if it's a complete loss. And then there is the recoverable depreciation. And that's really what we want to get to. That's the meat of the subject we're going to talk about. So they do this in two different parts for basically to limit fraud. This basically allows them to limit the excessive payouts and making sure that you're actually going to fix up the property. So after you repair the property or replace the damaged property, that's when they then pay out the rest of the recapturable or recoverable depreciation. So what is depreciation? Well, depreciation is the amount by which the value of your property has actually lost value over time. This can be due to the age of the property. This can be due to condition, wear and tear. It could also be just the natural obsolescence, which is whether newer models, newer homes have just kind of naturally decreased your value. So the most common method begins with estimating an item's useful lifetime and then reducing that by a fraction every year until it gets to zero. So to give an example of that, let's talk about like a roof. So let's just say your roof costs you $10,000 to do. Year one, the actual cash value that you would get is that $10,000 back. Let's just say they put that over a 20-year period. So by year 20, their actual cash value is zero, but the recoverable depreciation is $10,000. Where at year one, you're getting the actual cash value of $10,000. The recoverable depreciation would be zero. So I'm not going to go into all the details of how the insurance company figures everything out, but in general, you'll have an insurance adjuster come out after you make a claim, and they're going to figure out the replacement cost value, or the RCV, the ACV, which is the actual cash value, and then they'll also figure out the depreciation. Then you, as the insured, you would actually go and fix up the property and provide receipts and stuff like that, and then they would reimburse you. They'd first give you the ACV or the or a combination of the ACV and the RCV, and then once you fix up said issue, you would then get the depreciation recapture. Now here's where it gets interesting. Many homeowners will actually have a complete loss, and they'll get that ACV check, and they'll have to pay back their mortgage if there's a mortgage on the property, and they're going to go and buy another home, or they're going to go and move on with their lives, and maybe they then look to just sell the property as is and kind of just keep going on. Well, that depreciation recapture is just sitting there. It doesn't. The insurance company does have to let it after the date of the loss. There's generally a year to 2 years that it can be reclaimed. Otherwise, the insurance company will then just basically wipe that away, and they don't have to pay that out, and they're all happy. Well, you as an investor, if you are able to purchase a property from the person who lost the property, you as an investor can actually buy that property from the person that was insured and had the loss. And now you have the opportunity to recapture that depreciation as well. And one way to do that, that insurance company allows, and not all insurance companies is going to be the same, but a lot of them have this in their policy, is you can buy with like kind to get back that depreciation recapture. And what does that mean? So if the ACV value of the property is $100,000 or $200,000. It's a single family home. You now go find another single family home, valued at the same price, or two family or multifamily, whatever it might be. And now you say, basically working with your lawyer and the insurance company. And I'd highly recommend actually also getting a public adjuster, and I'll touch on that in a second. But basically you can now take that, get a sale contract and say, hey, I'm going to buy this like kind property in exchange for fixing up that property. And I would like to use, that depreciation recapture. And then basically they will then pay that out. Sometimes they'll pay it right out after you give the sale contract. Sometimes they'll actually wait for the actual close, and there'll be a transaction with your lawyer to get it all handled. But then you can basically use that money as a deposit down. And this can sometimes be tens of thousands of dollars onto that said property. Now, once you have that all said and done, you're going to have the new property that you've actually used none of your own money, but you've actually bought that other property. And now you have that, and then you still have the property that you purchased from the prior insured, and now you can maybe fix up that property if it's not that bad. I mean, often, these full losses are possibly recoverable. You can, still get them, rehab, and especially you as an investor might have a far lower cost than as a homeowner to get these things back up and operational. Or maybe it is completely lost, and you can have someone come out, demo the property or demo it yourself, and basically now have a building lot that you can then resell or develop yourself. So I wanted to touch on a little thing called public adjuster. And I would highly recommend working with public adjusters when you have insurance claims on your house. They're there to work for you, with you. Whereas insurance company sends out their adjuster, they're not there for you. They're there to pay out the least amount of money that they can for their insurance company, because they're working for the insurance company. They are third parties generally, but they're working for the insurance company. They're not working for you. So they're not looking out for your best interest. Whereas a public adjuster, yes, you do generally have to pay them a percentage of the claim, but I've seen, maybe you're paying 8-10% out to them. You're getting far more back from the amount of claim that you're getting because they're going to fight for every dollar that you can actually get. And they're going to know all the ins and outs of your policy. They're going to go through it with a fine-tooth comb and really help you get the most value. So I hope this was helpful. I hope you guys take a moment, hit the subscribe button. Also, do me a favor, if you have any questions about this, I know this was a lot to unpack. Ask a comment, and we'll try to get the answers, and maybe someone in the community can also answer the question, but we'll do the best we can. But this is something that is not well talked about and not well known. So I hope this was really helpful to you guys, and please like and subscribe. Thanks a lot.